thank you so much for sitting down with me.
It's a pleasure, Dani. Thanks.
So you've had an investor day, you've had earnings, there's been an election in between, but within all that, you and the team at Apollo said that you wanted to double your AUM by 2029 to $1.5 trillion. That is a punchy number. What gets you there?
Yeah, AUM, as we always say, is the output, not the input. Ultimately, if you're able to deliver good investments with good returns, the dollars will come. There is no shortage of asset managers providing beta out in the market. The key is to be able to provide alpha, and everything we do, the entire way we tune our business is to find those places where we can find excess return in the market. And our investors appreciate that, and that's really, at the end of the day, what's driving it.
Where do you think is the biggest opportunity to do that right now?
Lots of places. One of the areas we talk about a lot is, fixed income replacement. The market is waking up to the fact that the opportunity to just, carry your fixed income portfolio at essentially no excess spread is, nice, but the opportunity cost of doing that is pretty massive. And there are structural ways to earn excess return on that fixed income without taking more risk and without sacrificing meaningful liquidity. And more and more investors are opening up to that, and we've proven it with our own balance sheet for many, many years, and that's starting to become attractive to the market.
What about politics as a driver of growth? I know the market is really excited that with the Trump coming presidency, there'll be deregulation. M&A starts to swell to some degree. Do you share that enthusiasm?
Yeah, I'd say I'm a little more balanced about it, right? I mean, the economy, everything starts with the economy. And, the economy has been incredibly robust for the last several years in an environment that, let's be honest, has been, fairly anti-business from a regulatory, environment. I do think, there's hope and expectation with the new administration that there will be a more conducive environment to business growth, to allowing more M&A, and so that should help. But ultimately, I think things are dictated more by the underlying economy and business rather than the regulatory environment. That's an added, that can speed things up or slow things down, but doesn't really change the direction of travel.
There does seem, though, to have been more scrutiny from regulators on private equity, on private capital in general. Do you expect that that's going to ease off?
Hopefully. No. The reality is there's been a lot of rhetoric. I don't know that there's been meaningfully more definitive regulation, right? I think, to be fair, regulators are trying to understand as alternative investments, private equity, private capital, becomes a bigger part of investors' portfolios. They rightly want to understand, what it is, what does it do to the systemic risk of the system. I think they're figuring out that it actually doesn't change it. In fact, things like private credit reduce systemic risk. Private equity is an investment product like any other investment product and doesn't necessarily, increase portfolio risk. And so I think the more investigation that's happened, the reality is the more regulators have figured out that it's not inherently riskier. I do think, though, the tone at the top matters, and the nature of, is there a support for business growth? Is there support for M&A? Is there support for champions in the U.S. in industry? That makes a difference, and that's what I think we'll see more of.
So to be fair, is it fair to characterize it as animal spirits are going to be awakened regardless of what's happening in D.C.?
I think that's always the case. I think, DC can certainly make it more conducive.
Okay.
Yeah. There's other things too, though, that I think will benefit. When you think about retirement products, when you think about alternatives for individual investors, I do think there's going to be more interest in that, or more willingness to see that proceed.
Can you get into that a little bit? Because I know wealth products are really important from Apollo. That's a huge source of growth. And a lot of the Trump policies, at least as we know what they're likely to be and what he's promised, are going to help a lot of wealthy individuals. How do you sort of make Apollo inform it that you can take advantage of some of that to come?
Yeah. Well, and to be fair, we think we know. We don't actually know what policies are going to be. We'll wait and see. But I do think it's less about wealthy individuals and it's more about individual investors in general. Retirement accounts, retirement savings. We know for a fact that excluding alternatives from IRAs, 401ks, other DC plans has been a real detriment. Other countries have figured this out, and for a variety of reasons, we just have not seen that adoption here in the U.S. I think we're getting closer to a point where, with a little more impetus, a little more push, you will see that, and that's a huge game changer, right? Think about the 401k market, right? We ask individuals to put money away for the next 30 years to save for their retirement. Right? If we could get them an extra couple of percent, you don't need to take the most extreme risk. Just a couple of percent return compounded over 30 years is pretty massive. And eventually, good ideas prevail. And I think this may be the window where we see that push and that opening from regulators to be able to start doing much more of that.
Elsewhere, there is this fear, might be too extreme to explain it, but renewed concern maybe about inflation. And I know your colleague, Mark Rowan, has talked about that the Fed's cut was a cheap one and perhaps wasn't necessary given the economic strength we've had. The concern also stems from Trump policies too. How concerned are you to be operating potentially in an environment where inflation isn't as tame as we thought it was and maybe is more sticky?
Yeah, look, I've been pretty adamant about this. When we spoke a few months ago, I said, I think rates are going to be higher for longer because inflation is not tamed. The Fed can say what it wants. You just have to open your eyes and look around. Think about the last flight you were on and how crowded it was, or the fact that you're paying $85 for a steak and next week it'll probably be $90. Or housing prices, right? Everywhere people want to live, right? There's not enough homes. Housing prices are going up, notwithstanding, the backdrop of the rate environment. And so we see inflation not as beaten, but as suppressed. And the more the Fed cuts, the more you're lifting your hand off that lever to hold inflation down. And look, nobody's got a crystal ball, but we live in a world that is the mega trends that are driving the world today are pretty inflationary. You have things like the build out of the digital infrastructure. So between chip fabs and data centers and the power that's needed, that's $100 trillion we have to spend over the next decade. The decarbonization, the deglobalization of the economy, all of these things are inherently very inflationary. Then layer on top of that what might be, some of the new administration's policies that are, that sound inflationary, deficit spending, so some of these other programs that are going to add to inflation. It's very hard to say that inflation is beaten or inflation is over. That doesn't mean inflation is going to run away. It just means we're going to have to live with a higher rate environment for a lot longer.
And you've been really good and really right on this idea that we're going to have a higher rate environment. And one of the things you said at a conference in Berlin this year, in what feels like a lifetime ago in June, is that not everything is going to be okay, that we're going to have some refinancing coming into the market, and it's going to be a problem for a lot of private capital. Again, that was in June. Is the moment of reckoning nigh now?
For sure. We're getting closer and closer to this. As I alluded to back then, the private equity industry, invested in a lot of companies, over the 5 years leading up to 2022 before the rate change happened. Good companies, but at very full prices. So sitting here today, when private equity companies firms would be normally selling their portfolios, they're stuck. They're holding on to big portfolios of good companies, right? I'll posit that most of these investments are good investments. They just paid too much for them given the current rate environment. And so they are saleable, but maybe not at prices that these private equity firms would be happy with. And so they're going to hold on to them. And by holding on to them, you have grumpy LPs who aren't getting their cash back at the rate they thought. And then you also have refinancing issues, right? Okay, well, now if I'm holding this longer, I have to refinance it. And so how do I do that? Some companies will have no problem. Others will have to start being a little more creative. And we're absolutely seeing that. Part of our business model is to help those companies, those other sponsors that might need capital somewhere in their capital structure to help get through this next hump. Because again, most of these companies are actually good companies. the sponsor just paid the wrong price for it. Yeah.
Is the matter made even worse at this moment, though, than it looked in June, considering we might have more inflationary policies coming in 2025?
I think it only lends credence to my theory. We'll put it that way.
Okay, I think that's a great way to put it. The other thing we talked about at that time was you had done a JV with Intel to build out a big factory in Ireland. You said you wanted to do more deals like that. What does the pipeline look like for now, these energy necessary for AI type deals?
Pretty massive. There are, the energy is one component, but everything I was talking about, the deglobalization, the digital infrastructure, the decarbonization, all of these things are massive capital, needs for companies. And these companies just don't have access to all the capital they need. And so finding ways to partner with these companies, bringing the right cost of capital to the right situation, really spanning everything from investment grade all the way to private equity and everything in between, really is the future. And that's going to be, the name of the game for years to come. I mean, we're talking about hundreds of trillions of dollars that need to be spent. There's room for us 10 times over, and lots of others. And that's, that's the exciting opportunity. And being able to, partner with lots of amazing companies is what makes it great.
I just want to end with maybe throwing out a little bit of red meat to the team at Apollo.
Sure.
Private equity bonuses, according to Johnson Associations, are set to rise in 2024. That's even excluding carried interest. Is 2024 going to be a good year for bonuses, Scott?
Dani, you're killing me. It's a good year. Apollo has been blessed. We've had amazing momentum and continue to have amazing momentum. Fortunately, most of our employees are stockholders, and we're working really hard for our team, our investors, and our shareholders.
It's a great note to end it on. Scott, thank you so much.
Thank you.